What is the difference between transaction-based pricing and asset-based pricing? This is the Transition to RIA video series. It is question number 23. Welcome everyone, I'm Brad Wales with Transition to RIA, where I help you understand everything there is to know about why and how to transition to the RIA model. So in today's question, we're going to be talking about these two kind of pricing mechanisms used by custodians for transactions. So transaction-based pricing and asset-based pricing. Now on a previous video, and to be honest, I probably did these I could have done them in a different order, but on a previous video, and you should check out, I talked about, well, who actually, pays these fees? Is it the client? Is the RIA? There are some options. So if you haven't already seen that video, after you go through this one, I encourage you to take a look at that one as well. Again, who actually pays for these fees? But we're going to talk about the difference in this video between this concept of transaction-based pricing and asset-based pricing. And the key to remember with this is one of the ways that a custodian generates revenue. Again, as an RIA, you will receive 100% of your advisory fee. And so, it does beg the question, okay, if I'm the RIA and I'm receiving 100% of the advisory fee, how is the custodian making money or generating revenue? And so one of the ways they generate revenue is off of these potentially transaction or asset-based fees, and I'll do a whole separate video on how a custodian generates revenue, because I think it's important, to understand, because it is a partnership. The RIA needs to have a way to make revenue, and so does the custodian. So I think it just helps to understand both sides of that coin as well. And to be clear on these transaction charges or asset-based charges, as the RIA, you receive none of that. You keep 100% of your advisory fee, and 100% of the transaction charge or asset-based pricing is retained by the custodian. And that's for your own good as well. Obviously, the more revenue you can make, it would seem good. But for reasons I'll explain, that is at arm's length, and it makes it possible for you to truly tell the client, the only thing I receive for my services that I provide to you is what you pay me, is the perhaps 1% of the account balance there that I provide services for you on, and beyond that, I don't have any incentives or conflicts to use certain products or to trade more or less or anything like that, because the only way I'm paid is based on this 1% advisory fee or whatever it is you charge your clients. And so it does make it very clean. But just to be clear, again, you as the RIA would not receive any portion of the transaction-based pricing or the asset-based pricing. So let's go through both of those here one at a time. So we'll start with transaction-based pricing. So what that is referring to is, and this has changed, and I did a whole video on this of how much this has changed, that a year or so ago, pricing used to be much more prevalent in the conversation than it is now, but it is, as I'll explain, still relevant today. That real quick, a year ago, every time you did an equity trade in a client's account, or an ETF trade, or a mutual fund trade in most cases, or an option trade, there was a transaction charge if you're using this transaction-based pricing model. And so every time you do a buy or a sell, there was a transaction charge. We'll fast forward, and I'm not going to rehash all of it, because like I said, I did a separate video on that. But the custodial world has moved now to where largely most custodians no longer charge a transaction charge on equities and ETFs. That has gone to zero. That used to maybe be $6, $7, $8 a trade, and then it was kind of lowered down a little bit, and then now it's zero. But a lot of people don't realize this is when those headlines came out, trading costs have gone to zero. Again, for equities and ETFs, they've gone to zero. They still exist in not all, which I'll explain, but in a number of cases with mutual funds, they exist. Fixed income trades, they exist. Usually in options trades, they exist. So transaction charges do still exist, depending on what investment vehicle you perhaps are using at that time. And so real quick, just to run through them again, nowadays, the equity ETF world is generally now down to zero. And most custodians, not all custodians, on mutual funds, there generally would be a transaction charge unless the mutual fund you are desiring to use is on the custodians, as they say, no transaction fee list, an NTF list. And I'll do a whole separate video on what those are and what you should expect from them. But the main takeaway is that if a mutual fund is on that NTF list, you in turn don't pay that transaction charge. But if it's not on that list, there is indeed a transaction charge for every buy or sell that you do. And again, usually fixed income has a transaction charge. Option trades, sometimes most custodians would charge kind of a flat amount up front and then a per contract charge. A lot of the custodians have moved to where there's no longer that flat up front, but there's still a per contract charge. So you could consider that, transaction charge. So the main takeaway there is that transaction charges still exist. They exist a lot less than they once did because, again, equities and ETFs now, and in most instances, are at zero transaction charge. They still exist in some capacity in mutual funds and then some of these other investment vehicles. So the idea there is if you were to work in that transaction-based arrangement with your clients' accounts, that where applicable, there will be that transaction charge assessed. And like I said, I did a whole video on who pays that. Is it the client? Is it the RA? Do you have options? So I encourage you to dig into that as well. But that's how transaction-based pricing works. Now, the other one is asset-based price, and sometimes ABP people will throw around. And that idea is to say, as a custodian, I might come to you as the RIA and say, okay, as opposed to any of these transaction charges on some mutual funds and in options and in fixed income or whatever, or maybe I'm still a custodian that does charge it on equities and ETFs, as opposed to having a transaction charge that kicks off every time a buy or sell occurs. We'll just instead set a basis point, and it could be 3, 4, 5 basis points, something like that, where we will assess this asset-based price and charge against the value of the account, and in return, it will essentially be across the board, no transaction charges. There will be no issues with some mutual funds. There will be no per contract on the option trades. Instead, it will just be X basis points across the board in the account. So I'd say that's the simpler to understand. It's essentially a wrap program is what you're creating with that, because again, it's all included. A lot of advisors themselves, might structure it as part of their fee. And so the client is just perhaps currently at your current firm used to not seeing any transaction charges. And that's a way to essentially replicate it. Now, I would tell you there are pros and cons to all of this. And that's one of the things I help advisors think through is just because you're doing something one way currently doesn't necessarily mean it will be the best way to do it in the RA model. And so again, I have that conversation all the time with advisors to help them think these things through. But of those two approaches, it's certainly fair to say transaction-based pricing is much more used than asset-based pricing currently. And I think, and I'll talk on it, I think that trend might at some point change. But you generally see that word, especially now that equities and ETFs have now gone down to zero, and that's reduced the frequency and cost of transaction-based pricing in total. That's why it's, even if it wasn't already, kind of running ahead of asset-based pricing, it's certainly more prevalent even now. And like I said, I did do a separate video on who pays that, but really quickly. Usually by default, whether it's transaction-based pricing or asset-based pricing, by default that is charged to the client. An RA generally has the ability to elect to absorb those instead if they would choose to. But there's a lot of nuances with that you need to think through. So again, I encourage you to look at that video. But just the quick note there is generally that, again, by default, the client would be charged either one of those, whichever way you set up the account. And the RA has the chance to maybe absorb it instead. So the question is, which of these two is better, transaction-based pricing or asset-based pricing? Is never a perfect answer, because every RA could be different. Every style of how you manage assets can be different. So I don't want to give some impression that this is the way you should go versus another. But a couple of things I did want to throw out there that you'd want to consider. So, the first one is maybe your clients are currently, in a traditional wrap arrangement where they don't see any transaction charges, and maybe you feel they're going to be very sensitive to any transaction charge, even if it's a lot less than it once was, being introduced into the equation there. And so maybe in that case, you look at that asset-based pricing and you just kind of build it into your fee structure. Now, I would tell you, this movement to zero for equities and ETF trades is only called a year old. And for all in existence before that, the custodian model generally charged those transaction charges, and countless advisors made that move from more captive, say, wirehouse type environment where maybe they had that kind of wrap fee arrangement with their clients into the RIA model, where they did just have to explain to the client, here's how it works, here's how the custodian generates revenue, here's the fee I receive. And in those cases, those clients were paying those transaction charges on everything. And it just shows you it is possible to position it correctly with clients and help them understand why those fees exist. And quite frankly, that's just an easier conversation now, because a large portion of it is now priced at zero for the transaction charge. But just know many advisors that, if you haven't made the move yet, that came before you, did it and when there was full transaction charges, and obviously we're able to work that through with their clients. So then the second one kind of related to that is, now so many trades are, at this zero transaction-based pricing that maybe you don't even, need to create kind of a wrap account. Maybe you don't use mutual funds, and maybe you only rarely do or options contracts. And so, maybe, oh, hey, all I do is equities and ETFs. And then that essentially solves your problem. You essentially do transaction-based pricing, even though there is no transaction charges, because again, in most of those cases, depends on your custodian, but in most of those cases, those trades would be going off at zero. And then the last thing is, let's say you as opposed to using almost solely equities and ETFs, you do use mutual funds. But again, to the degree you can use mutual funds that are on the custodian's no transaction fee list, NTF list. And again, I've done some videos on this. And those are usually fairly expansive lists of mutual funds. It's the bulk of mutual funds generally that the custodian makes available are on those lists. It's certainly not all, but it's not like, oh, only 10%. It is the majority are on those lists. And if you are someone that makes maybe models that you use with your clients, and they're comprised of mutual funds, and if you make those models solely of mutual funds that are on the NTF list, again, those will go off at zero per buy and per sell. And so at that point, you are, arguably better off just going with transaction-based pricing, because you won't have any transactions to have a charge against, because they're all going off at this NTF list. So the kind of main point is there is no clear winner. There's pros and cons. Again, something I help with advisors, I'd be more than happy to think it through with you, is to really look at what's your current situation, what's the current arrangement with the client, and then look at, well, what are custodians currently offering, and how might that look if I were to make a change, and what adjustments would I need or want to make as part of that. And so it's not a black and white answer, because every advisor situation could be unique. And then something else just to keep in mind, of course, this all needs to be disclosed properly to the client. In the RIA world, disclosure is the name of the game, whether it's conflicts of interest or anything like that. And so there are some, and again, that's part of the explanation to the client of, client, here's how it works. I have an RIA, here's the custodian, here's the relationship, and you just have to walk clients through that. But you also want to make sure it's properly disclosed, and that's usually in your ADV. And depends on whether you have the client pay the transaction charges or asset-based pricing, or whether you as an RIA choose to absorb those as well. There could be some conflicts of interest with that specifically need to be disclosed. And again, if that's of interest to you, go back. You can find my video specifically on who pays for these fees, the transaction-based charges or the asset-based pricing. And I go into the disclosure requirements, the potential conflicts of interest that I think you want to think through before you just assume, oh, I'll definitely absorb the fees, or I'll definitely use asset-based pricing, or I'll definitely use transaction-based pricing. You want to factor all this in. And of course, you could just call me and we could quickly have that conversation as well if you'd like. And then my final thought is, again, the industry has shifted. And so a year ago, transaction-based pricing transaction pricing was across the board on every product you did, unless it was on this NTF list concept, the equities and ETFs and mutual funds. And now we're at a point where Equities and ETFs are at zero. We still have pricing on these other transactions. The question is, what does the future bring? And I won't claim that I know the future. I think there's a lot of people, you go back 2-3 years ago, didn't necessarily assume would be in this situation with zero on some of these things. So it's hard to tell what the future will bring. I would note though that a custodian does need to generate revenue, and there are different ways. This is not the only way a custodian generates revenue. Again, I'll do a whole separate video on how a custodian generates revenue. But the challenge is when these revenue sources are declining or go away entirely with transaction charges on equities and ETFs. That makes it harder for the custodian to be able, provide services for you as an RIA and to invest in their platform to make it a better platform for you to use. And so it will be interesting to see where the future goes. I mean, it could come a time that asset-based pricing becomes kind of more the norm, and we do need to charge this asset-based pricing to cover our cost of actually doing these trades and sending out confirms and all those sorts of things. So the world is always changing. The good news is, as an RIA, it's a very competitive marketplace out there. So you have a lot of choices with different custodians and different value propositions. And again, I'm more than happy to help you kind of think through why one might be better for you than another. Again, not better in general, because for each advisor, it could be different. But there's just main point being that the world changes, the world will continue to change. It's the same thing with your business that you are dealing with, and we'll just see how things work out and what those changes are to come. So with that, like I said, I'm Brad Wales with Transition to RIA, where I help advisors just like you understand everything there is to know about why and how to transition to the RIA model. So think of talking about the topic today. What is this? How does transaction pricing work? And what is this? I've heard this asset-based pricing. What are the differences? What are the pros, cons? Why might I consider one versus the other? This is exactly what I help advisors think through. I want to make sure you are informed ahead of time before you maybe start being faced with some of these questions and some of these decisions. I want you to know exactly what you should expect to hear when you ask of those custodians, hey, how does this work? What would the pricing might be? I want to make sure, again, you're ready to go and educated ahead of time on how that works. So happy to help you with any of those kind of conversations. And if you're not already there, head on over to transitiontoria.com. You can see plenty more videos I've posted. Like I've mentioned here, I've done some. You can find them on the website. I've done white papers. And then the simplest thing is right there at the top is a contact link. Just click on that. You can instantly and easily schedule a specific date and time to have a conversation with me. We can talk about very granular topics like this, if you like today's topic, if you'd like, or if you want to just begin that macro conversation of here's what my current practice looks like. What might that look like in the RIA model, and everything from the economics to the flexibility to the control to the responsibilities. I'm happy to have that conversation with you. So with that, I hope you found value in today's video, and I'll see you on the next one.